Africa Finance Corporation became the second African multilateral after the AfDB to issue a perpetual hybrid bond. To put it very simply, it's a bond with no fixed tenor, which has some equity characteristics. Now, this $500 million issuance had a coupon rate of 7.5%, and it got about $1.1 billion in orders. In the same week, AFC announced that it had gotten ratings from S&P's China unit and also China Chengxin International Credit Rating. Banji Fahintola is the head of financial services at AFC. When we spoke some hours ago, I started our conversation by exploring the rationale for looking for these two ratings.
We have a very strong track record of raising money across the world. The Eurobond market, we've been there severally. We issued an hybrid bond last week. We've been in Japan, we've been in Korea, we've been in the Middle East. We've done so many transactions, and the Chinese market obviously is also a deep capital market, which we've been looking at for a long time. And in order to access that market, you obviously need to have a rating. And so the whole idea of getting a Chinese rating is really to prepare ourselves for a potential panda bond issuance and, access to the Chinese market.
In terms of accessing, or rather raising longer-term debt from the Chinese market, what sort of numbers and tenor do you have in mind for that initial issuance?
Difficult to say. It's early days. In an ideal world, we like to maximize tenor. As you know, we finance infrastructure projects, and naturally infrastructure projects are long tenor, so the longer the tenor, the better for us. But we also have to be realistic, right? I mean, it's probably going to be the first time in that market. We have good relationship with other Chinese entities, by the way, but that's on the loan side. But being the first of its kind, if we're going into the panda bond market, we'll be guided by what investors want. We'll be guided by what our banks that will work on the transaction want. And then we'll try and find, hopefully, a sweet spot where we can issue for the first time. And our intention isn't to just be a one-off issuer. It's potentially, we probably will be accessing that market from time to time. So if we don't get the 10 on the first attempt, over time, as we build the name recognition, I expect that we'll be able to, build out a curve.
With respect to pricing, though, because looking at the performance of the hybrid bond that you raised last week, right, $500 million got at least twice that in orders, and that came in at a coupon rate of 7.5%, which is roughly a spread of about 310 or so basis points above where US 10-year treasuries are at the moment. Do you reckon you'll be able to raise at a much lower coupon rate in the Chinese market?
I don't know. I mean, I wish we would. As an issuer, my major target is to get the lowest funding cost as much as possible. And that's the reason why we are obviously, issuing all over the world. We've issued in Japan on the loan side, we're in Korea, we're in the Middle East where we have very strong support from the banks. We have so many DFIs that support us. So when I look at it, I look at the overall cost of fund on the balance sheet, and for us, how do we ensure that our cost is as low as possible? So going into the Chinese market, again, I'm not sure. I don't know how things will pan out. The hybrid bond, we have to remember, is a capital instrument, right? So it's not our senior. Our senior currently, I believe, is trading in the 5% area, which is much tighter over treasuries. The hybrid bond, because it has equity kind of component on it, there's a subordination premium on top of that. And based on the day we issue, the subordination premium actually showed a very good outcome for the institution.
Right. So the US dollar might potentially remain relatively strong, at least in the short run, given all the uncertainty we're seeing around policies on trade, on taxes, on fiscal policy coming out of the United States. And yes, last week you had this successful issuance, right, of the hybrid bond. But what's your assessment of what market conditions are like in 2025? Are they still likely to be as tight as they were last year, or perhaps even tighter?
I think that's a very interesting question. And the reason why we also did the hybrid bond in January was because, as we know, the US itself was going through political transition. There was an imminent Trump presidency, which started this week. And all those things had impact on the financial markets, right? There were conversations around tariffs. Towards the end of last year, there was a bit of a belief that inflation was going down. But again, we've seen, the data out of the US showing that inflation may actually not be going down, maybe going up, which means that rates may be higher for longer. If you marry that with a potential trade war, tariffs, etc., those things could be inflationary. So generally speaking, that's what really made a lot of issuers, including ourselves, to come out and issue in January, right? January, just before the transition, I guess a lot of people didn't want to be caught up in the transition. So I think from an emerging market perspective, the first 10 days of January, for example, I think over $60 billion was printed in the bond market. About 23 billion of that was from CEMEA region. We were one of those as well. So I think the market generally at some point will find this level. I don't think the Fed is going to cut rates as much as we expected sometime last year. Rates may be higher for longer, and that has implication. It means that emerging market credits, have to think about how to absorb potentially higher interest costs.